All right, today we're going to talk about a really fascinating strategy called sector rotation. Think about it this way. What if the economy wasn't just some random chaotic thing? What if it actually had seasons, just like the year? That's the whole idea here. It's about knowing when it's time to plant and when it's time to harvest. So let's figure out what season the market's in right now.
I mean, it's a feeling every single investor knows, right? You do all your homework, you pick what you think are great stocks, but then you look at your portfolio and it's this weird mix. Some things are soaring, others are just sinking, and you're left wondering, what's going on? Well, the answer often isn't just about what you own. It's about when you own it.
And that is the core idea behind sector rotation. At its heart, it's a strategy that says, hey, the economy has seasons. And if you can learn to read the economic weather, you can shift your portfolio into the industries that are just about to get their moment in the sun.
Okay, so first up, let's break down these 4 economic seasons and really understand the cycle.
So the whole thing really unfolds in 4 clear phases. You've got the economic spring, or early recovery. That's when things start to thaw out. Then you move into the economic summer, the mid-cycle expansion, when things are warm and growth is strong. After that comes the economic autumn, the late cycle peak. Think of it like a harvest. And finally, things cool down into the economic winter, a recession. But the key thing to remember, just like the real seasons, after winter, spring always comes back around.
All right, Section 2. This is the playbook. So who actually wins in each of these seasons?
So let's start with phase 1, the economic spring. Imagine coming out of a really tough winter. Things are finally starting to look up. GDP isn't shrinking anymore, it's actually turning positive. Inflation is pretty low, and maybe most importantly, credit starts to get easier to find. You can almost feel that sense of optimism in the air. So who does well here? Well, think about it. When credit becomes cheap and easy to get, who wins first? Financials and banks, of course. And what does all that cheap credit fuel? Big purchases. So real estate and construction, they start to boom. And when people start feeling more confident about their jobs in the future, they finally go out and buy that new car or other big-ticket items. That's a huge boost for what we call consumer discretionary stocks. Okay, next up we're moving into the economic summer. This is the mid-cycle expansion. The recovery isn't new anymore, it's really hit its stride. Growth is strong, it's steady, businesses are investing, they're hiring, they're confident. Honestly, this is usually the longest and, well, the most pleasant phase of the whole cycle. And now you start to see a really clear shift in which sectors are leading the market. As all these companies grow, what do? They pour money into upgrading their tech, their software, their systems. So information technology becomes a real star performer. All that expansion also means factories are running at full tilt, which is fantastic for industrials. And to build all this new stuff, well, you need the basic building blocks, which is exactly why the materials and chemical sectors really start to take off. And then comes autumn, the late cycle peak. You can really think of this as the harvest time. Growth has been great, but now it's peaking. And you can start to see some cracks appearing. The big one? Inflation starts to creep up. And as investors see this, they get a little nervous, and the market can get a whole lot more volatile. In this phase, the playbook it flips completely. It's not about offense anymore, it's about defense. As that inflation starts to bite, where does money go? To hard assets that tend to hold their value. Things like energy and other commodities. And at the same time, that nervousness about the future, it pushes people towards safe haven sectors like utilities. Why? Because people always need electricity, and these companies often pay reliable dividends no matter what the economy's up to. And finally, winter arrives. A recession. The economy is actually contracting now, and the mood in the market is pure defense. The goal isn't finding the next big growth story anymore. It's about preserving the capital you have. It is the classic flight to safety. So where do you find safe ground in an economic winter? Well, the golden rule is to focus on what people need, not what they want. People still get sick, right? So healthcare tends to hold up well. They still buy groceries, soap, toothpaste, which is why consumer staples are so resilient. And let's be honest, in today's world, internet and phone service are basically non-negotiable. That makes telecom another key defensive play. Okay, on to part 3, timing the seasons. I know what you're thinking. This all sounds great in theory, but how on earth do you know which season we're actually in? Well, it's not about having a crystal ball, it's about following the data.
You know the pros? They're basically economic detectives. They're watching this whole dashboard of clues, what we call leading indicators, to see where we might be heading. They're looking at things like the yield curve, which is kind of the bond market's way of predicting the future. They watch credit growth to see if banks are feeling optimistic or fearful. An indicator like the manufacturing PMI, that tells them if factories are ramping up or shutting down. And of course, they are hanging on every single word from governments and central banks.
All right, let's get into our final section, strategy and pitfalls, because it's crucial to look at this with a balanced, practical approach.
So, a really popular way people actually do this is with something called the core satellite model. It's pretty straightforward. The core, that's the big chunk of your portfolio, maybe 60 or 70%, it stays in stable, long-term investments. But then, you use these smaller satellite positions to make your tactical plays. Tilting a bit towards financials in the spring, or maybe utilities in the autumn. This way, you can try to capture that seasonal upside without betting the entire farm on being right.
But of course, we've got to be honest about the risks here, because there are plenty. The biggest one? Timing. If you rotate too early or too late, you could miss the whole move, or worse, get caught in the downturn. And sometimes, the economic data just gives you a false signal. It happens. It's also really easy to get burned by putting too many eggs in one hot sector basket, or, poof, getting totally blindsided by some unexpected government action. So yeah, it's a powerful strategy, but it is absolutely not foolproof. So when you boil it all down, what does success with this strategy really depend on? It's not about your gut feeling, it's about discipline. It means having a systematic process. It means waiting for multiple signals to confirm that the season is changing, not just jumping on the first headline you see. It means always staying diversified. And it means making gradual, deliberate shifts, not these huge, abrupt, risky bets. So, let's wrap this up. Is sector rotation some kind of magic crystal ball for the market? No, absolutely not. No strategy can perfectly predict the future. A much better way to think about it is as a smarter compass. It's not going to tell you exactly what's over the next hill, but it gives you a really powerful framework for understanding the economic terrain you're walking through right now, and for pointing you in the right general direction no matter what season comes next.